Palantir reached all-time highs this week, and it doesn't look like it's going to stop, with price targets by analysts being revised higher and higher, showing lots of growth over the next few years and beyond. We're going to take a look at this company, deep dive. As always, we're going to have a quick update to their income statement, top line revenue, as well as their bottom line net income. We're also going to discuss some of the health aspects of this company, total cash versus their total debt, and we'll also see how they're performing versus some of their competitors over the last few years. We'll discuss the mass insider selling that we've noticed over the last few months, and we'll look at the institutions, get an update. Are they still buying more shares of this company quarter on quarter over the last few years? And we'll also talk about some of their metrics. We'll focus on the free cash flow, their growth, as well as looking at their ROIC and net debt. We also want to take a look and see exactly whether or not a lot of the analysts are bullish on this red hot artificial intelligence growth stock. We're going to take a look at why the price surged not too long ago with a new contract being given to Palantir, and we'll touch upon a few things from their Q4 highlights that does really signify that this could be a very strong turning for this company. And finally, we'll look at whether or not the S&P 500 inclusion in 2024 is possible and the outcomes in terms of how bullish this is for the company. Don't forget, we will run it through the valuation model. We're going to get to the intrinsic value as well as our acceptable buy price, given that investor margin of safety, see what Wall Street new forecast is for the next 12 months. And in today's episode, we're going to look at a three-tiered approach for the valuation. We're going to look at a low growth rate moving forwards, a medium and a high, to understand whether or not we do see this happening in the future. So let's start off with the historical performance. Now we can see over the last year they are up 216%, currently trading right there towards their 52-week low, which they hit this week. Now over the last 5 years, we can see initially in 2020 this was around $10. It reached an all-time high, as we can see here, of $37, $38 at the beginning of 2021. It does currently, however, offer a 81 forward PE, which does get a lot of investors scared given how high it is. We will discuss that. And the market cap now sitting at 58 billion. This is a company, now whilst we look for 3 to 7% on other companies, this is really expanding their top line at a rapid rate. 743 million in December 2019. December 2023, from that latest annual report, we're seeing 3 times growth just over the last 5 years. On that granular level as well, increases year after year, so very strong. But when we look at the bottom line, very interesting to note, they had a net loss, so the brackets depicts a loss, negative 580 million. They had a loss pretty much every year for the last 4 years. And in December 2023, the first year where they reported a bottom line net income. So this is very positive, and this could be the turning for the company that really propels it into a very strong company in terms of their share price, as well as their future performance and profitability. So lots of interesting factors to note there. When we look at the health of the company, total cash versus total debt, 1.1 billion of cash and short-term investments in 2019, 3.7 billion in the latest report, so they hold around 3 to 4 times as much cash as they did 5 years ago. Now, when we compare that to their total debt numerically and directionally, it has in fact dropped 396 million, gone down to 229. So pretty positive. They've increased their cash quite dramatically whilst reducing their total debt, always a strong positive sign. Now, if you want to compare how this company is doing to others in the application software industry like Roper Technologies and some other well-known in this industry, we can see over the last year, total return Palantir, the best performing, up 215%. When we extend it to the last 5 years, we can see again one of the best, in fact the best performing, up 175%. So bear in mind, past performance has been very strong from this company, but just something to always remember, that because they've done this in the past, it doesn't necessarily mean it's going to be very strong in the future. In terms of insider trading, now we have taken a look at both buys and sells over the last month. Now what we've noticed is a lot of selling by insiders, notably as well Alexander C. Karp. We can see here sold over 1 million worth of shares, giving him around 24.8 million. Now, this is interesting to note, although what we can see here along this column, it shows us the price since every insider has sold over the last month has gone up pretty strongly between 5 to 13%. As I always say, insider selling isn't necessarily a bearish signal. They sell for whether it's personal reasons or potential financial reasons, but always good to note when we do take a look at just over the last 7 days, we can see no insider buying or selling. So something to bear in mind, but as always, it isn't necessarily a bearish signal. We have 34% of institutional ownership currently, 588 million worth of sales by the institutions over the last 12 months, 7.4 billion of buys during the same period. So a lot more buying by these institutions over the 12-month period. And interesting to note, not just over the last 12 months, but every single quarter, Q1, Q2, Q3, and Q4 are more buying than selling, with the largest buy in Q2. So bear in mind, institutions are very bullish on Palantir. As we can see, they have been buying tremendously every single quarter. But as always, never copy institutions. It is very important to do your own due diligence. Now we're going to take a look at some bullish signals for this stock over the next few years. And the first thing to note here from this article from the Motley Fool just a few days ago, what they do say here is, and we're going to discuss this shortly, Palantir, they want a major army contract which adds to an already impressive pedigree. We're going to take a look at those contracts that Palantir have. But what they are also noting here, that investors should be even more excited about the company's commercial business, which is growing like gangbusters. And their third and final point is that even though it may look expensive, remember when we looked at the PE, it does look very high. At a first glance, the looks can be deceiving, as that isn't the full story of this company. You shouldn't just look at the PE ratio. So let's very quickly take a look at what this showed. So just a few days ago, it surged because of a 178.4 million contract with the US Army focused on AI. So very bullish for this company. We will look at the number of contracts they have, which seems to be increasing every single day. They are a very, very strong company that is growing very, very rapidly. So we can see once this was announced, the shares did jump on Wednesday morning. From then, it did hit its all-time high. And essentially, the contract will fund Titan, which is the tactical intelligence targeting access node ground system station that collects data for long-range precision fires. It is, interestingly, their fourth largest contract by annual revenue run rate, and their shares were up around 10% in the early trading of Wednesday, contributing to more than 57% gain the stock has seen since 2024. Now, very impressive. The reason for this, as we're going to see a few highlights from their Q4 earnings, what we can see here is that US commercial customers count grew 55% year on year and around 22% quarter on quarter. They've closed 103 deals worth over 1 million. This will now be one extra on top of this, and this is 2 times what they had around a year ago. Now, if we purely look at the top line, their revenue grew 20% year on year, 9% quarter on quarter to around 608 million. Very positive, with both commercial revenue growing 70%, absolutely incredible, and the essential commercial revenue from non-US 32% year on year. On top of that, even more positive, their adjusted free cash flow looking very strong, $305 million with a 50% margin. And this is the 4th consecutive quarter of GAAP operating profitability and the 5th consecutive quarter of GAAP profitability with that 15% margin. So lots to love with this company. It is increasing quarter on quarter, year on year, moving in absolutely the right direction. On top of that, if you do want to be even more bullish, we can see here, whilst this was in December, the question still remains whether or not Palantir stock will join the S&P 500 in 2024. They now meet the criteria to be able to enter the S&P 500. Last Friday, unfortunately, when they were rebalancing it, they didn't make the cut. One thing I did want to point out though here, which is what we should expect if they are put into the S&P 500, companies that were included, so other high profile stocks recently are Uber, which gained around 6.2% on December when it joined, Airbnb, which jumped 7.2% on the news in September. So lots to bear in mind, that even though they are still up a very, very strong amount, when they are to be included, hopefully some point in 2024, we will be expecting another nice jump around the single digits or possibly the low double digits to what is already a very, very strong company and a very, very strong growth period over the last year. And we can see right there now at the 52-week highs, which will go even higher over the coming years. Now, Before we take a look at the metrics and jump into the valuation, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any other of our articles, all completely free, click on that pinned comment below and you can gain instant access. Now, in terms of this company, we do like to look at the free cash flow per share, as the earnings is susceptible to manipulation by management through accounting. What I love is when you look at companies, they've gone from negative cash flow to positive. This is why when some of the companies we review on the channel have negative free cash flow, and you may be wondering why we review them, because what happens is when that free cash flow turns positive, that is when you start to see a very strong run in the share price. It's gone from negative 10 cents to 32 cents in 2023, moving the right direction, flipped from a negative to positive in 2020 to 2021, and in 2024 expected to grow again, so looking very positive on the growth for the free cash flow per share. Sales growth as well, nice to note, double digit every single year. Now you could argue it may be slowing down as it has been dropping from 2020, nonetheless looking very healthy, and with these contracts that do seem to be increasing, such as the Army contract, which is their fourth biggest in terms of annual revenue, this sales growth in my opinion will continue at double digits for quite some time and could possibly even see triple digits depending on these contracts moving internationally as well, as we have discussed on a previous episode. So numerically speaking, they have gone from 600 million sales to 2.23 billion. And another thing to note, shares outstanding, they have issued equity. So if you were a shareholder in 2018, your position would have been diluted from around 0.544 billion to 2.3 in that latest quarter. Now, in terms of ROIC, we can see it is positive in 2023, given they did turn a profit. Previous to that, it was a net loss. But what is nice to note here, it has been moving the right direction over the longer term. 2024, 2025, I would like to see some strong double digit, just to give us faith that management are able to effectively allocate their capital. The same can be said for the margins, again moving in the right direction. We do note there was negative quite some way as well in 2018, but since that point moving in what we like to see as a positive margin. Free cash flow margin, the same could be said, although we see positive free cash flow over the last 3 years, and 34% in the more recent year is a very, very strong metric. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Now this shows us the balance sheet strength, effectively showing us over the last 5 years and next year it is expected it won't even take them 1 day to pay off all of their debt net of cash on hand. A phenomenal balance sheet for this company. So let's jump into the valuation of Palantir. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we get to the intrinsic value by the averages of these 4 models. As we can see for today's episode, we only believe the DCF model to be relevant. So we have the free cash flow year on year. As we can see, the average growth rate negative due to the fact that they did have negative for quite some time. Forward looking, we've gone for 25%. With that discount rate, we get the present value of future free cash flow and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we can see here we have that sign of undervaluation. Now, for today's episode, we've gone for a low, medium, and high outlook for the forward free cash flow growth. Now, what we have gone for is what we believe to be the medium. If you were more of someone who believed looking at the lower rate at 20%, we would plug in 20% here, and we could see we'd have a sign of overvaluation. Now, if you were someone who believed actually it should be around 30%, and remember, bearing in mind with these numbers, just the last year was up 280%, you would see an intrinsic value of $42. So if you had a low growth rate target, upside would be negative 14%, medium 18%, and high 61%. So it really does depend on what category you do believe the growth. If for whatever reason you believe that these numbers you'd like to go higher or like to go lower, if you do grab a copy of this model from the pinned comment below, you can run your own numbers through, whether it's for this company, others in your watch list, or even if it's those in your portfolio. So let's take the 25% medium to the intrinsic value final stage. And given that the DCF model is just the intrinsic value, we get an intrinsic value here of $31. Now, the current price at $26, we use that margin of safety of 10%, which we use if we believe it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. Is then acceptable up to $27.56 if we believe this. We keep going till it's near the current trading price, and we can see right now a 15% margin of safety based on our estimates and judgments, with the current price not too far off. So 15%, and what about Wall Street? Well, they're forecasting around $32.50 with upside of 25%, so they are very bullish on this stock. We recently, in fact, had an analyst upscale their target from $30 to $35, so we have been a little bit more conservative here at $32.50. So there is a lot of upside with this, essentially looking at what analysts are saying. As always though, do let me know your thoughts in the comments below. Do you agree with some of those growth rates? Do you believe they should be higher, lower? Do you agree with this forecast? Is this one you are adding consistently, or maybe one for whatever reason you are bearish on? We'd love to hear. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.